Hey guys, Andy here, and welcome back to our channel. And make sure you subscribe and smash the like button. And today we'll be going over the potential threat of a recession from commercial real estate and regional banks that might happen in 2024. I'm sure we all remember what happened to Silicon Valley Bank, and the Federal Reserve had to step in and bail them out because the trickle-down effect to other banks would have been massive. And guys, this took place around March 2023. I have a wonderful article to go over with you guys from the Wall Street Journal. The title is "Bank Crisis Plays Out at America's Smallest Lender," so the small regional banks. And pretty much this article is overall explaining what is going on with small regional banks, smaller banks around your neighborhood, your town, or pretty much I would say the mom and pop banks. Just summarizing what went wrong, what took place, what happened to them, and how they're trying to put things together and how they're trying to weather the storm and exactly what happened to them. And I do have a few things highlighted here. We're gonna go and guys, this is the name of the bank owner. I don't know if I'm pronouncing this right, Doug Hartley. So just a really local bank. So when he goes to the restaurants and whatever he's doing around the town, people are asking him questions about, hey, is my money safe, and etc. Hey, what's going on? Is everything good? Is everything okay? So industry, Bus Shares with some of $5 billion in asset is the parent company of 6 banks with 24 branches scattered across a stretch of farms and ranches in eastern Texas. It's one of the small banks in rural America whose local focus, has been, a strength and inspiring years of loyalty from their neighbors to keep money down the street. So many of these banks are now reckoning with the decision they made when money was abundant and rate was low, crushed by the Federal Reserve rapid interest rate. So the rapid increase in interest rate that ran up extremely high at a really short amount of time has really hurt these banks because pretty much what they did is they took the money and invested long terms and locked it in with treasury yield and I think 10-year treasury yield. So they park that money somewhere where they can't access it for 10 years. And now people want their money and they're having trouble giving their customers who deposit money at the bank their money back. So which is causing a pretty good big trouble for them. So this is probably pictures at that local bank here. Welcome. It's a pretty small bank. Industry is currently more than 75 million underwater because it's piled up into long-term bonds when rates were low. Those bonds plunge in value when banks' liability have been exceeding its asset since soon after the Fed started hiking rates in 2022. So because the interest rate rise, so it's pretty messing up things for the banks. Let's go down here. Community bank typically focus on plain vanilla lending, making a lot of smaller dollar loans to businesses and households that fuel the economy. Usually stay close to home, serving deeply loyal, deposit with timing, diversity, and reach. So in the wake of the pandemic, business model has, been was problematic, where they flooded with deposit and loan growth had been slow. So when people have money, they take less loans. So people really had money during the pandemic with stimulus packages and everything going down and a lot of, free loans and stuff like that. It made it extremely hard for banks to actually loan that because people that need a loan. So banks typically make money off lendings and lending money out to people around the neighborhood, so they can charge fees and interest, so they can make pretty good money off that, so they can meet the day to day. While normally considered safe, the market for those securities fell. So what they did is they took all that cash, they parked it at a long term interest rate when interest rate was low. So the longer they push it out, the more they get on the return. So they locked it in for a very long time, so they can make more money. And what happened is that bond price, when interest rate goes up, it makes the price of the bond go down. So they can't sell the bond and get their money back until they wait for 10 years. So they have to wait for 10 years to unlock that interest. Otherwise, if they bought the bond for $1,000, they'll be getting it maybe $800, $700 for it. And they don't want to lose, that type of money per whatever amount that they bought. So just a pretty good example. I do have, a couple kind of like charts or example how bond works for those who don't know. I will go over that pretty soon after I'm done here. So in 2020 and in 2021, industry deposit jumped 23%, but the loan demand fell very low, and the industry decided to buy more securities, which is bonds, treasury yields, securities. So net income at community banks fell 20% in the third quarter. So they hurting, guys. So they losing a lot of money. They're not making enough, and the industry profit plunged 93%. So regional banks, local banks in my own neighborhood are really taking a beating at the moment. They really hurt. And so if we keep scrolling down, Here the Fed has signal it's nearing the end of interest rate hikes, which is pretty good. It's gonna ease a lot of things for them. If you're a community banks are sometimes the only ones around for miles, would triple through local economy. So when they leave, credit often goes away. So these local banks that are funding their local economy and providing loans to small businesses around the area and then keeping that economy moving. Once they go under, guys, it's gonna affect a lot. Yeah. So, guys, let's take a look at what exactly happened. As far as like, I want to give you guys some form of like a visual, so you guys can see. So let's click here. What I want to explain here is this is bond prices, and this is, it says bond yield, but pretty much interest rate. As we all know, when the pandemic happened, the Federal Reserve lowered the interest rate to nearly zero. So when that goes down to zero like that, bond prices go up, right? So the value of the bond prices go up. So we're gonna pretty much, let's pretend this is the price of housing and this is the interest rate. So interest rate is low, housing typically go up, as we pretty much observed that the housing market went up at least 30-40% during after the pandemic or over that stretch period till now. So housing prices literally ballooned, went through the roof because interest rate was low, and there's a lot of factors as far as inventory and supply, and there's a lot to it, but pretty much the main driver was low interest rate. So pretty much this period has low interest rate, bond yield, interest rate, and then bond prices. So let's see. I also have another one to show you guys again right here. We can see again, same thing, bond prices, bond yield. You know how it kind of works. See, interest rate is going up, that means bond prices going down. So when interest rate goes up, bond prices go down. So that's what happened, right? That's what happened to the bank. Let's see. Interest rate started going up, the price of the bond that they bought went down. So when interest rate goes up, price of the bond goes down. When interest rate goes down, price of the bond goes up. So the bank bought it here. They bought it and locked in a bunch of interest, bunch of yield, well, treasury bond, I meant to say, for like 10 years. They locked in that money for 10 years, several millions or billions of dollars or trillions or for some. So all these regional banks locked in their money because they wasn't making money off giving loans to the average Joe that walks in. Hey, I need a personal loan. I need you to finance my car. People had money. They were buying stuff cash, so they didn't need a loan. So they trying to find ways to make money. So they went here and parked this for a long time, about 10 years, because that's what gave them the most return. And then now, all of a sudden, interest rate went up. Boom, last minute. Everything happened within 9 to 6 months or 12 months. Went up really high. So that price that they paid right here is down here. So they can't just sell and get out and get their money back. Let's say if they bought it for 1,000 and now it's worth, I don't know, 600, 700. They don't want to lose all that money, or maybe sometimes it's probably worth half, who knows, but they don't want to lose all that money. Speaking, let's say if you put in $1 billion, it's now 500 million. They don't want to lose all that money because they will probably go under, or because they owe a lot more. They lose people's deposit. So they don't want to go under, guys. So they locked in. They have to wait until 10 years for that to clear, so they get their money back at this price. So bond is, you have to wait for that time to get your money back, and the amount of interest, or whatever you make off that money. But you have to wait. It's a waiting game now. So these companies don't have money to give people who's withdrawing, who come in, hey, I need my $20,000 back or $80,000 back. They don't have the money, which is causing some of them to go under. That's exactly what happened at Silicon Valley Bank, and they had to get bailed out by the government because of it. But that's exactly what happened. People was trying to withdraw their money and they didn't have the cash because they parked it for a very long time, so they can get money, so they can kind of like meet interest and meet their bonus or whatever. So they waive the risk to that. So let's pretend this is the housing market. When interest rate goes up, supposedly the housing market is supposed to go down. The price of housing is supposed to go down, which we haven't seen yet. Who knows when it will happen? But when interest rate goes down, price of homes goes up. Pretty much during the pandemic, interest rate were down very low. The housing market just shot to the moon, and the average Joe can't afford a home anymore. But that's exactly what happened. I do have another article to share with you guys. Over here is from Yahoo Finance. Financial disaster is looming for American commercial real estate. Here's what experts see happening next year. If we scroll down, I got a few things highlighted here. There's a potential financial disaster looming over America's debt-stricken commercial real estate sector, and a boiling point could come as soon as next year, and the real estate expert warned. As you can see, right here, Silicon Valley Bank, what happened to them? About $1.5 trillion in debt to the sector. Definitely went under, had to get bailed out. So here, these are the main factors that might cause commercial real estate recession or whatever's going on over there. So office prices are set for another 20% decline in 2024, according to recent estimate from Capital Economics, and cited weak growth and still. So bank losses. Bank could lose 160 million from commercial real estate, which makes up about a quarter of the average lenders. So pretty much regional banks, local banks are also at risk because they loan out to businesses and real estate investors to get those real estate properties, and then they pay the mortgage every month and refinance their debt or whatever extra, etc. How they do it. Here we have another analysis of where they say they're predicting the losses of half 250 billion. So banks are gonna get hurt once the commercial real estate started trickling down. Continue reading. Let's say rising default, around 40% of all commercial real estate properties are already in a state of negative equity, which means the building is less than the outstanding debt. So this is not a good sign, guys. And then zombie offices too, guys. Office building could soon be abandoned as work from home trend continue to take a hold. So companies are really finding ways to save money, guys. I know a company right now who's leaving a building and they're moving to another smaller building at a local downtown area because it's cheaper. They don't feel like they need to pay a giant office building to put all those people in it. Companies are finding ways to save money. They don't see the necessity of having a giant office to put everyone in anymore. They could just do hybrid and kind of rotate, do 1-2 days a week, just to keep the company culture. So the zombie effect, rising default rate, bank losses, and this right here will probably trickle down to the regional bank. They're already having their own troubles here. So imagine if the commercial real estate thing happen and occur and probably make things a lot worse. Some of them can actually maneuver and get out the situation, but if the commercial real estate combined with that, it'll probably really hurt them a lot more and speed up the process in 2024. That might trigger to job loss and pretty much increase risk for recession. And guys, as we wrap up, a potential commercial real estate collapse will take a lot of smaller banks with it, in addition to regional banks facing their own troubles at the moment, which is making it harder for local businesses to get funding. Once a majority of the smaller banks go under, it will take a lot of local businesses down because of the lack of funding, which may lead to a recession. That's all for today, folks. Don't forget to like and share and subscribe for more updates on economic trends and much more. Thank you for tuning in. I will continue to work hard to bring you more updates about the current economy and what my predictions on that is. Thank you.